Mixed bag of labor market data this week, including weekly jobless claims this morning that came in slightly below expectations. That's all just a preview for tomorrow when we get the November jobs report. Economists estimate 190,000 jobs added last month, an unemployment rate of 3.9%. That's going to be the last major data point before the FOMC's December meeting next week, where the Fed is expected to hold rates steady. Joining us now is Richard Clarida, currently PIMCO Global Economic Advisor and a former Fed Vice Chairman. Great to have you, Richard. So what's the most important data point that you're going to be looking for in tomorrow's job report beneath the headline?
Well, I think potentially revisions. Sometimes the data does get revised. Also be looking at both the household survey and the payroll survey, and look to see if the trend of slowing job growth has continued.
Get back to Richard Clarida. I'm sorry if we cut you off there on a thought. First of all, I want to give you a chance to finish that.
No, as I said, obviously the labor market is incredibly important to the economy and to the Fed. We've had a trend of slowing employment growth and some modest rise in the unemployment rate. So obviously we'll be looking to see if those trends continue tomorrow. More broadly,
we're seeing, and we just had this with Broadcom's report, certainly with Lululemon's a few moments ago, revenues were a little bit weaker than some might have hoped, but profits strong because they want to hold to pricing. As we think about how this holiday season continues to pan out and what we see employers, retailers do in January based on how their profitability has looked and how the sales have looked, what are you concerned about how this holiday season is going to set us up for 24?
You know, it's a great point because it's relevant in either direction. If firms are really aggressive in trying to keep their margins, then that'll make the Fed's job more difficult because it'll mean inflation's more stubborn. On the other hand, if firms are not able to keep those margins, that makes the Fed jobs easier, but obviously it's not great for earnings. And so, you know, typically, John, we do see this in past business cycles. When we get towards the middle part of the cycle, there's a handoff from pricing power to workers, and the way that balances out will be an important story in 2024.
Richard, it's great to have you on the show. We know the economy is cooling. We know inflation is moving in the right direction, and that's cooling as well. Do we know, can we yet wrap our arms around the magnitude of it, especially as you do have a Fed that's basically said it's going to be a lot harder, potentially, and it's going to be a lot stickier to get from a 3 handle on inflation down to a 2?
Well, that's right. And of course, that's been a theme at PIMCO as well, you know, the last mile. But I think we want to look at the good news. The disinflation progress really has been remarkable in the last 18, 24 months. And so the amount of heavy lifting the Fed needs to do from here on is certainly not all that much, we would think. In fact, we think the Fed thinks that they're done. There is a risk that they may need to do more. But importantly, Morgan and John, the Fed has indicated, and we think that Chair Powell will repeat this on next Wednesday, is they can start to think about cutting rates even before inflation gets to 2 if they're convinced that the progress is real. And we heard some commentary along those lines from Governor Waller. So I think there's a difference between how long does it take inflation to get to 2 and a separate question, how long does it take for the Fed to start thinking about rate cuts?
Is the market too aggressive in what it's pricing in terms of rate cuts? And I guess just as importantly, as someone who's sat in the room to have these types of conversations before, what is going to be the methodology that enables the Fed to actually start to do that before we reach 2%?
Yes, to your first question, Morgan, yeah, we do believe that the 5 cuts that are priced in for next year look aggressive to us. That could happen. In September, for what it's worth, the last time the Fed did its projections, it had 2 cuts next year, and something in that 2 to 3 range probably as a baseline makes more sense than 5. You know, in terms of sitting in the room, yes, I had that privilege for nearly 4 years. the Fed is looking at a large body and range of data, but at the high level, they're going to want to be convinced that, inflation is less than 3% and on its way to 2%, and they'll be looking at not only the price numbers, but also the wage inflation data as well. So I think they'll look at a wide range of data, but the important point is they are absolutely focused on succeeding, and I think the Powell Fed will succeed. But as inflation does continue to fall, they'll entertain rate cuts starting next year.